Meeting is recording. All right, guys, welcome to episode 2, day 2 of the Trading for Dummies series. This is Easy Effects, day 2. We're joined here with Mr. Sam, and we're ready to teach him further into the markets, some deeper insights into technical analysis and how to actually start approaching your strategy and actually finding trade setups. So, Sam, do you want to give us a little recap of what we learned on session 1?
Yep. So session 1, learned some main terminologies, I guess, market analysis,
Yeah,
technical analysis.
Yeah.
Technical analysis. Yeah, that's a shit. But restart it, bro. Quick time. My bad.
Nah, you're calm. All right.
But what's it? What? My bad. Go.
All right. So, Sam, can you quickly recap us of what we covered in session 1? What did you learn?
Yes. So technical analysis, learned some, how to identify an uptrend, what consolidation looks like, what a downtrend looks like, and then learning what break and retest, correct? Break and retest looks like. And I actually went ahead and went onto the markets, right? Did a little simulation here, right? And I managed to identify a little break and retest, and it went up. So I'm getting my eye already. Let's go.
Full-time funded trader. Series is over, guys. The guy's profitable. We'll leave it.
Yes, sir.
Nice. All right. So in today's session, we're going to kind of be building off of those concepts and looking into further like behavioral technicals. So we're looking at impulsive and corrective waves today. I'm going to give you an insight into beginner Elliott wave theory. We're going to be covering Fibonacci retracements, how we use them, how I personally use them. I don't really use them too tough, but it's just good information to know. Going to be covering psychological levels and a little bit further into DXY correlation and stuff of that nature. So let's get started. My guy, I'll share my screen.
Lots of fancy words.
Lots of fancy words, mate. Get your notepad out. We're going to be writing.
Yeah, I've got it here. Right. This is going to be worth millions, mate.
Yeah, $1 million. All right, cool. So the first thing we're going to be starting on is a very important concept, and that is impulsive and corrective waves. But very quickly, I'm going to check price action because they're pre-New York right now. Actually, that's a little bit early. No, we'll leave it. So this has been featured on my YouTube channel multiple times. I've mentioned it a whole bunch, made multiple videos on it. I'm going to continue to do it because it's a very important concept. That is impulsive versus corrective. Some other terms that you may hear for this, because in the Forex space, we have 5 million terms to describe the same concepts, but we also hear distribution. This is more the smart money term for it, but it's distribution versus accumulation.
Okay.
It could also be a manipulation versus accumulation. It depends who you're chatting to. Or very simply, it can just be pushing versus exhausting.
All right.
I mean the same thing, it's the same term. I generally use the term impulsive versus correcting or pushing and exhausting. Cool.
There seems to be a theme here, like you mentioned, a lot of words meaning the same shit.
Yeah, exactly. Yeah. A lot of people like to take like one term, they rephrase it, they rename it, they give it their own like a complicated name that sounds cool. And then they're like, yo, I discovered this concept. This is my patented trading. Like no one knows about this. And then meanwhile, they're trading the exact same system.
That's funny.
It happens a whole bunch. Yeah. Cool. So impulsive versus corrective. What does this mean? So the market is only ever in 2 waves. Now, this is based off of this theory I'm going to be teaching you. It's based off of a concept called Elliott wave theory, which we're going to be covering in a little bit. Now, Elliott is some dude who discovered a theory about how the market moves and the waves and the patterns and stuff like this. This is like a little minor section that's taken out of that. And it's a section that I personally believe applies to every strategy, regardless of whether or not you trade Elliott wave or you don't. So the market is only ever doing 1 or 2 things. We're only ever in 1 of 2 phases. What are those 2 phases? Well, those phases are impulsive or corrective. What do those actually mean? Well, let's start with impulsive. An impulsive phase is simply when the market is doing 3 things. When it's pushing with high volume, a high volume push. is generally a decisive movement. And I'm going to explain what that means in a minute. So ignore my spelling. Yeah, solid spelling.
Nice, calm, bro. I'm literally more dyslexic.
All right. So it's a decisive movement. What it means is there's typically no wicks or small wicks.
Okay.
So I'll give you a visual example of this in a moment. It's wicks, and it's usually covering a large distance. Cool. So these are the three characteristics you're looking for in order to identify an impulsive movement. So an impulsive movement can be in either direction. It can be bullish, it can be bearish. It's not fixed in either direction. And it's just simply when price covers a large distance in a short duration of time. So it's the big movement that happens very quickly. How do you find them? Typically speaking, when you look at a chart, your eyes will naturally be drawn to the impulsive because it's just the biggest movement. You see right here, this two big white candles. This would be an impulsive because we've had a high volume push. We've had these big candles. Within this high volume push, granted, we have left wicks, but it's all about the ratio relative to the size of the body. See how we have a big body here?
Right.
The wick is pretty small. So it's not really relevant for this movement. So we have a big body, small wick, and in the direction we're pushing in, we also have a small wick. But again, the body's far bigger, so it doesn't really matter. We've covered a large distance in a short duration of time with broken structure. We can see that we've pushed in an area with like this decisiveness with a lot of volume. That's essentially an impulsive.
Okay.
To show you a bullish impulsive, we can come right here. These three candles. Again, strong movement to the upside, quite large bodies. Granted, we are still leaving wicks, but relative, again, looking at context, the bodies are a lot bigger. We can see that price is still moved. It hasn't met a lot of resistance. And it's just visually speaking, it's an impulsive. Cool. Pretty self-explanatory. Now, a corrective is the exact opposite of this right here. So you'd be looking for, not that. So you'd be looking for a low volume movement. Also
so literally like that little green guy up there above.
Oh, yeah.
No, not there. Above the thing.
Yeah.
Yeah.
I see where you're coming from. Yes and no. Well, we'll get into that in a sec, yeah. So you're looking at a low volume movement. It's usually an indecisive move. So you'll typically have 3 or more candles that are inverting color. So you see on the 2 impulsive movements that I showed you, if they were the same color candles. So right here we have bearish candles in line, we have bullish candles in line. A corrective movement, you're likely to have movements like this. So bullish, bearish, bullish, bearish, bullish. So it's going back and forth. Price doesn't know where it wants to go. It doesn't have a clear direction. There's no clear momentum. It's just even the price itself is confused. Okay. You know what I'm saying? And another characteristic, just to flip this last one, is it's not covering any large distance. So what you'll notice is that throughout these corrective movements, price is moving up and down. So it's still in a range. It still kind of has a little bit of volume. But overall, it doesn't really move anywhere. It's kind of in the same area, like a consolidation. And it's doing a whole lot of nothing, is essentially the idea. You can see that right here, if we take a look at these 2 moves, this impulsive, this bullish impulsive, bear in mind we're on an hourly time frame right here. This bullish impulsive, in the space of 3 hours, we cover about 250 pips. Like we cover quite a large distance. You can see it's a nice movement in 2 hours, 250 pips. It's moved somewhere. In comparison to a corrective movement, like back here, if you look at here, this corrective movement lasts literally a day, so 24 hours.
Yeah.
You see, overall, we pretty much end up at the same place we started. There's no movement. Like it's literally a break even. If you're in a trade, you'd be holding it for a day, panicking, going up and down, and then even. So the name of the game and the whole idea behind this concept is we want to avoid the correctives and trade the impulsives, because the impulsives is where the money is at. The volume is where the money is at. Our goal as traders is to find an impulsive movement, identify an impulsive, get in and get out before the impulsive ends. Generally speaking, the way the market sort of likes to formulate a lot of the times is you'll have an impulsive that leads into a little corrective. So, for example, if we're looking at a trending market, you have impulsives to the upside, and then you have those little corrective periods that kind of retrace against you, like this.
Okay.
You have an impulsive to the upside, little corrective that retraces like this, etc. And that is an ideal example of how an impulsive and corrective wave would form in a nice trending market.
Cool. But as we know, it never usually looks exactly like that.
Exactly, yeah. Typically speaking, you're much more likely to find something a little bit more messy like this. So even this sort of price action we're looking at right here is pretty much the same example, but just a little bit more messy. So we have an impulsive. See these 4 candles, little impulsive, and then you have that corrective period right here.
Okay.
A little mini impulsive, another corrective, little mini impulsive.
Okay.
This is also an impulsive. Again, sometimes you will have a back-to-back impulsive, but it's less likely to occur than an impulsive corrective move.
Okay. So, yeah, I get you.
Generally speaking, if there is a double impulsive,
there'll
probably be a reason for it. Maybe price is tapped into a key level, or it's rejecting some sort of psychological zone, or something's happening for price to react the way it reacts.
Right. Okay.
Generally speaking, cool.
So it's out of, well, not. I feel like when I say like norm and stuff like this, like I'm coming to understand the more that like you teach me, right? That like nothing's fucking normal about the market, but there's just like guidelines that you can kind of go by. So
yeah, 100%. So I would say there is like a norm. There is like a common occurrence, common like patterns and shit that form.
Okay.
But it's not about like how do I say this?
There's no rules to the shit.
Yeah, there's no rules to it. The market
there's rules that you can follow, but just because you follow them does not mean it's going to like 100% work, right?
Yeah, for sure. Yeah, like there is no rules. The market can do anything at any given moment. It's completely random. There's no like no guidelines, but there is common occurrences that like just again, it's all a probability game. There's things that are more probable than other things to happen, and that's all we're basing our trading off of.
100.
So that's essentially impulsive and corrective. Now, what I want you to go ahead and do is on your laptop, your computer. Cool. I want you to go ahead and share your screen.
Okay, cool. Should I head over to trading view?
Yeah.
So what market should I go to, or currency should I go to?
Let's go US30 to go to an hourly time frame. Cool.
I'm not logged in on this account. Give me 2 seconds.
Cool, bro.
How do I? There we go. Wait.
Yeah.
How do I screen share on this? I only use Zoom usually.
At the bottom, the arrow with a box.
Arrow with a box. Arrow. Share now.
Yeah. Yep.
Okay.
Just for the people at home who are watching this YouTube series along, we're going to be progressing into some more complicated topics. I am going to be sharing a large portion of my system on the series. I'm not entirely certain if I'm going to share 100% on YouTube. I'm still debating that fact, so let me know what you guys want in the comments. I'm sure you obviously want the whole system, but we'll get to that when we get to that. But we are going to be covering a ton of psychology stuff about funded accounts, about taxes. I'm not a financial advisor, so don't quote me on that. But we'll get into it. All right, cool, Sam. So what you want to do, is go to indices. Indices. It's next to crypto. Go right on that little up there.
Yeah.
Same search bar, yeah.
Oh shit, here. I see it, my bad.
Indices, yeah. And
US30.
Yeah.
Sweet.
And launch chart.
Calm.
Are these your chart colors?
No. Don't know. I was playing about with them, but I just used what you were using. Okay.
You've inversed what I'm doing.
Oh, shit.
Yeah.
No way. Bro, I feel like a grandpa when it comes to this.
That's calm.
It is a sleek website though, isn't it?
It is.
So cool. All right, yeah, cool. I'm here.
Remove your volume at the bottom as well.
This.
Yeah. Just double
How
click
do I,
that.
how do I do that?
Double click it.
And then,
Just untick it.
oh, sweet. Yeah, I was wondering why I had that. All right, cool.
All
On
right,
a
cool.
3 minute time frame.
Yeah, go to an hourly time frame.
Oh,
Yeah, sick. All right, cool. Now I want you to identify bearish impulsive for me.
sorry.
A bearish impulsive.
Bearish impulsive. Okay, that's it here.
Yeah, why is that a bearish impulsive?
Because it's gone down dramatically quickly, and mainly the body is so much larger than the wicks.
Cool. Show me a bullish impulsive.
This.
Yeah, that would be nice. Show me another bullish impulsive.
Another bullish. Here.
Yeah. Show me a bearish impulsive.
Here.
Yeah. Another bullish.
Here? No. Here.
Yeah, I'll count that. Yeah. Show me a corrective.
Here.
Yeah. Show me another corrective.
Here.
Yeah. Show me corrective that leads into a impulsive.
Okay.
But not that one there.
Okay. This? No, wait. Would this count? But it's going down a bit before.
Let me see.
Here.
Yeah.
Yeah?
That whole thing is a corrective. Yeah.
Okay, cool.
Yeah. Cool. Show me one more corrective that leads into an impulsive.
Okay. Here.
Yep. Nice.
Sweet. Pass the test.
Yeah. All right. No minors, no majors.
Yes, sir.
Yes, sir. All right. I'm gonna take over screen
Sweet.
share.
Should I stop screen sharing?
Yeah.
Sweet. 2 secs. There we go.
Cool. So one thing to pay attention to is the fact that the market is fractal and that there's a lot going on within like little mini movements. So when you're looking at a corrective, there's usually like a little mini impulsive within a corrective. What I mean by that is like if we're super zoomed in right here, you can actually look at this little movement right here, this little section, these 4 or 5 candles as like a little mini bullish impulsive. And technically it would be a little mini bullish impulsive within this context, but if you look at the wider context and the wider picture of what's actually happening, is that movement is just part of one big corrective. So in actuality, this whole thing right here, sorry, I don't know why it's not red. Yeah, this whole thing
Same
right
with consolidation. If you're too zoomed in, you'll be like, oh, I'm in an uptrend. But
here. Yeah, exactly. So this whole thing is the corrective. This whole thing is the impulsive, even though like within this movement, there's little retracements. The whole thing is still the impulsive because it's just one big movement. See what I'm saying?
Yeah, I do.
Right here, the whole thing is the corrective.
Yeah.
This is a little singular one candle impulsive. This one right here, and then it leads into another bullish impulsive.
Yeah.
So on and so forth, etc. But the point is, you're always one or the other. Like there's no in between. You're either impulsive or you're corrective.
Okay, cool.
So keep that in mind. Now, a habit you want to start getting into when you come onto the chart is ask yourself, what is price currently doing? Are we impulsive? Are we corrective? If price is corrective, you're probably waiting for something to happen and you're waiting for the impulsive. If price is impulsive, then you're like, okay, cool, it's go time. It's time to something. Is a general idea. All right, nice. Let's continue past this point.
But real talk, you are very good at like teaching.
Thank you.
And explaining and breaking down. Oh,
I taught a bunch of people stuff. Some of which are funded. So it's working.
Doing something right.
Yeah, clearly. All right, blessed. Let's continue. Cool. So at this point, we've done beginner market structure. We've done some key levels, a little bit touched on it. Impulsive and corrective waves. Let's get into trading sessions, kill zones, and a little bit about like liquidity and stuff like that.
Sweet.
Cool. Are you familiar with any of the trading sessions?
Asia session, New York and London, right?
Yes, sir. Do you know when they are?
No.
Right. So we've got a London session, which is from 8 a.m. and this is
Yeah.
UK time, 8 a.m. to 4 p.m.
Okay.
We have New York, which is 1 p.m. to 9 p.m. And you also have a 2:30 stock exchange open within that, which I'll explain in a moment.
Right.
Sometimes it's 1:30, dependent on daylight savings, it moves.
Okay.
We then have Sydney.
Oh shit.
Sydney might be after Asia. I think Sydney is after Asia, actually. The fact that I don't know this shows you that it's just so irrelevant because we're living in, and it's the two that you'll never end up trading, and you don't want to trade anyway for a lot of reasons.
Right.
But Sydney and Asia, I'm not going to give you the timings for them. One, because I don't actually know them, and two, because it's just irrelevant to your life.
Yeah.
Unless you go to Australia and you want to start trading AUD, in which case it'll probably be 8 a.m. Because I'm pretty sure the session open in the local time is always 8 a.m. So,
Makes sense.
So these are the four main trading sessions. Now, you can see by the first two that the sessions actually overlap. So New York and London are open at the same time. Equally, Asia and New York are open at the same time. Sydney and Asia are open at the same time. And then Sydney and London. No, I'm pretty sure it's Asia and London. Regardless, they all overlap.
Yeah.
There's a period where they're all trading simultaneously. Now, the trading sessions are what is going to give you the volume. It's what's going to give you the momentum. It's what brings people to the market, liquidity, all of that. So you want to be trading around the sessions. Now, a general rule of thumb that you want to be operating off of is you're generally looking to enter and exit your trades in the first and the last hour of session open or session closure, because that's when you're going to get the most amount of volume. That's typically when you're going to get the breakouts. Typically when you're going to get the impulsive movements will be in the first hour. Some people refer to this as like session kill zone. If you look at ICT and some of the smart money concepts, they go heavily in depth about the first hour, the session kill zone, and price taking, liquidity, and all sorts of nonsense. But the point is, you're just going to get a big ass candle first hour. That's, yeah, cool. Now, every session is going to provide more volume for the instrument that they mainly trade. So what that means is in London session, the GBP pairs, so for example, GBP USD, GBP JPY, etc., anything with a pound is going to have more volume than anything without a pound because it's session. It makes sense.
Makes sense.
So for New York, any USD pair, gold, silver, etc., anything that's USD based will benefit from USD opening. Same thing for Asia, Sydney, etc. Pretty self-explanatory. Now, for what I'm teaching you to trade, we trade the indices, which is US 30, Nasdaq, and German 30. German 30 is kind of separate by itself, and we'll get into that probably in like one of the final sessions because that's more a pound pair. But for NAS and US 30, which is the main thing that we trade, it's prime time for us to be trading during New York session because New York is going to have the most amount of volume. It's just, it makes more sense to trade New York. So we usually start trading at 1 p.m. or maybe slightly pre-New York at like 12:30. So like you're sitting there, you're getting ready, seeing what setups are occurring, etc., and you're preparing yourself. Now, we want to avoid trading during London, even though London session does have volume. Each session has its own unique characteristics and own unique like tendencies of how price tends to react and tends to behave. Now, I don't want to jump too far ahead because this is a session we'll be covering like later on. But a typical characteristic for London session is London session loves to fake out. Like we can be in a nice fat uptrend or whatever, and you're looking for that standard break and retest for London, and it looks like it's about to give you that break and retest, and then just London Open just dumps on you, fakes you out, and then continues like this. That's just a common characteristic of London. It just happens very often, and that's why you want to avoid trading London because it's just annoying to trade. In comparison to New York, a common characteristic is it just continues. It likes to rally through. So like you're much more likely to be able to catch these continuation movements and ride it out because it's cleaner price to trade. And this kind of links back into session one about, you know, the different types of uptrends, different types of price Yeah. So you're just much more likely to get that cleaner price, that much more swing high, swing low sort of vibe in New York than you are in recession.
Okay, so it makes sense. So we trade New York mainly because, like, well, if there's a higher chance of it being cleaner, then it's better to trade less and just trade well when you're trading, if that makes sense.
100%, 100%. Again, if you wanted to go down that Hamid route, which a couple of people have done, and you want to trade London session 8 a.m. in the morning, you're better off trading a forex pair, GBP, USD, GJ, or some other thing, and you can apply the same concepts, but it's just obviously a slightly different approach, and you need to do a lot of back testing and data collection on that end.
Right. Okay, makes sense.
Let's swing back around to that. But that is the main trading session. Just to give you an actual timing as well, is usually we're actually trading from 4:30 to, I would say, like 3 p.m. If you're not in the trade by 3 p.m., you're probably not trading that day, more than likely. So that's like your little trading period. That doesn't mean you have to be sitting there from 12:30, like sitting there waiting, anticipating. Like you can just set an alert, you can glance at the chart, go do something else, come back. But that's like the main section where you're paying attention.
Okay, cool.
I'm going to quickly cover a little section on some high impact news, just because it's important. This right here is good old Forex Factory.
Oh, cool.
With this website, it's a website that you use to track economic news, does everything for you. So it's go to forexfactory.com/calendar. I'll send you the link after. Check on the day that you are trading. This is super important because you do not want to get violated by high impact news. So you check on a day you're trading before you execute any position. Always come to Forex Factory and look at the news. What you're looking for is these red folders. Any red folder is high impact news. High impact news is any sort of economic event that is going to directly impact price action. So whenever you see a high impact folder like this, at that time, you're probably going to get a big ass candle that would just start doing the madness.
Right.
It's essentially like gambling because you can't predict that candle. You can't anticipate it. Even if you know if the news is going to be positive or negative for a specific currency, you still can't anticipate how the candle is going to form, how big the wick is, etc.
Right.
It's a madness. And in terms of risk management, which we're about to follow up with, it takes your risk management out the window and it can completely fuck you up. This is how people lose funded accounts, valuations, personals, how you liquidate yourself.
Right. So it's literally like putting like fucking peas on black.
Yeah, literally.
Okay. Yeah, because you can't determine the probability.
100%. So any red news you avoid. Amber is fine. You can facilitate amber. Yellow is irrelevant. So just the red ones. And obviously you correlate with the pair that you're trading. So this right here is red USD news. So that means you're anticipating a reaction on anything that is USD related. Furthermore, USD is kind of everything because USD controls the market. The dollar controls the whole market. So generally speaking, if it's USD news, that's like the most impactful news you can get. If it's like pound, for example, it's like GBP, like some shit like this, that's irrelevant to you. You can still trade, like, doesn't really mean anything. But if it's USD, then it will fuck up your whole position.
Okay.
Cool, nice one. But yeah, highly recommend check Forex Factory.
No, definitely. I'll note it down. That's interesting. That's cool that they do that shit.
Yeah.
And it's free.
It is free.
Fair enough. They could charge for that.
They could. I don't know why they don't charge for that.
Yeah, honestly, just like a little like £5 a month. Think about the MRR.
Yeah, I actually don't know why they don't charge, but let's not bait this out for Forex Factory, see this and start charging.
Yeah, exactly.
Yeah, I actually don't know why they don't charge for this because this is like
even if it's just like a little £2 a month, like
this is the most used economic calendar.
Yeah,
that's actually crazy. Maybe someone needs to hit them up and just take the pit on that. The market would be pissed.
Reach out and be like, yo, we want you to monetize your audience.
Yeah, we'll do it, bro. Bring them onto the agency, mate.
Yeah, trust.
Onto the agency. All right, solid. That's the wrong color. Solid. All right, can I get the black? Yeah, look at that. That's so irrelevant. All right, risk 101.
Yeah.
Arguably one of the most important concepts in trading that we're going to be covering is the concept of risk management, how to manage your risk, make sure you don't lose your portfolio in a single position. Without risk management, you have nothing because you can trade, you can be a sick trader, you can have a 99% win rate. And then on that one time you lose, you fuck everything. So it's super important. Especially the goal of this series is obviously to get you funded at some point, to get you on a big a prop firm account, get you making some payouts. You're never going to be able to achieve that if your risk management isn't tight, because the whole reason that people lose the funded is they can't facilitate the risk management. So that's what we're getting into. Risk 101. So there is a golden rule when it comes to risk management, and it's as easy as this right here, and it's just the 1% rule. Do you want to figure out what the 1% rule is? I'm sure you know.
Only risking 1% of your total account.
Yeah, pretty much 1% of your total balance is considered correct risk management.
Oh, okay.
There are certain scenarios where you could go 2%. I would say anything above 2% and you're starting to take the piss a little bit. 2% I would consider is aggressive risk. There are very few scenarios where you'd want to be doing that. As we kind of progress further and we start talking about the blueprint to passing funded accounts and my personal approach and how I like to tackle them aggressively and stuff like that, we will be talking about 2% risk and being a little bit more aggressive, sometimes stacking multiple 1% entries against stuff of this nature. But generally speaking, when it comes to your standard trading, always 1% risk per position. Now, this also extends to only one trade, because there's no point having 1% risk and then you're in 5 positions, because then you're risking 5%. So you need to imagine if all of them simultaneously hit SL, what's my risk on the table? So that's why 1%, max 1 trade. Now, this extends further. It will let me go down. Solid. Let's leave it like that. Yeah, cool. So this extends further. So for argument's sake, if I have a 100K account, which is pretty standard account size when it comes to the prop firms. So on a 100K account, my standard risk per trade is 1K. Pretty decent amount.
Okay.
Now, the system that I'm going to be teaching you to trade is a 1 to 2 risk to reward. So that means our average profit is 2 times the average loss. So we're usually risking 1%, and the average gain will be 2%, which would be 2K if you're on 100K. So you're risking 1K to make 2K usually. Sometimes it will extend further than that. There'll be scenarios where you go for a 3 or a 4, sometimes even a 5. Indices do have a tendency to just obliterate your target and just do a madness, so it does happen. But generally speaking, that's your most like common 1 to 2. Now, the reason that I mentioned this is to come into win rate and come into percentage win rate and stuff like this, because it's all kind of interlinked. I know we're jumping around here. But your percentage win rate, so the amount you're winning, we'll just go 50, is going to determine how big of a win you need to win to remain profitable. So the more you're winning, or the higher your percentage win rate, the lower your risk to reward ratio can be and still remain profitable. The lower your win rate, so I'm not sure how clear I'm being here.
No. Continue. I think I'm with you.
Cool. The lower your win rate, the higher your risk reward ratio has to be for you to make money. For example, if my win rate is 50%, which means I lose half of the trades that I take, I need my risk to reward ratio to be at least a 1 to 1.1 for me to make profit, because that means that anytime I win, it wipes out my loss, and anytime I lose, it wipes out my win. So it all cancels each other out. So I need to be just above that to make money.
Right. Okay. Makes sense.
In comparison to if I had even, let's say, like a 10% win rate, which is very low, that means out of 100 trades, I only win 10. But my RR, my risk to reward ratio, is a 1 to 12, for example. Anytime I win 12 times my loss. That's still profitability because these numbers play out.
Okay.
If that makes sense.
Yeah.
Now, there's a lot that goes into picking what RR you want to trade and how you want to approach it, because this also heavily links into your psychology. I'm not going to try and spell psychology, but I'll just do that.
Squiggle. Yeah, there we go. Brain.
Yeah, links in very heavily to your psychology, because even though this is still profitable, and arguably this might be more profitable than someone who's winning 60% of the time, but only has a 1 to like a 1.5 system, for example. Arguably, this might be a more profitable approach to the market, but in terms of psychology, it's more difficult to manage your psychology, because you need to think, if out of 100 trades, I'm only winning 10, 90 trades I'm losing. Those 90 positions can come consecutively, so they can come loss after loss after loss after loss.
Right.
How are you going to handle your psychology during that period? Are you going to be able to continue to trade the strategy after you've taken 40 losses consecutively? Are you going to be able to confidently execute trade number 41 with the same confidence you execute the first one?
Yeah, anybody who says yes is like probably lying.
Exactly. There's a lot that goes into it. Furthermore, are you still going to have an account at that point? If you've taken 40 consecutive losses and you're risking 1%, where's your account?
Yeah.
So maybe you have to try. Yeah, exactly. Like there's a lot that goes into it.
Okay.
Firstly, for me, and what I'm teaching you to do is way trading. Like I said, is a simple 1 to 2. But for a 1 to 2, you actually only need a 40% win rate to be profitable. The system that I'm teaching you has around a 63% win rate, give or take. It depends how you trade it, obviously, and how you execute it. But this is very much profitable. And again, there's a bunch of data and stuff that I can show you that backs this, but that's essentially the strategy. The point is that with this system, you should be winning more than you're losing. So out of 10 trades, you're winning 5 or 6. And you're also winning more than you're losing. So it's profitable in both directions. And it's also beneficial for your psychology because you won't flip out from losing trades, is the idea.
Yeah.
Cool.
I like the fact that, like, I don't know if for the people watching at home, this is like confusing, but like it's not like the thing that I like about this is like, although when you're first explaining it to me, right, and illustrating it, it's like, okay, there's a lot going on, and then it all just makes sense. It's very calculated, isn't it? All of it.
Yeah.
I really like it. It's like,
Sick, man. Nice. Cool. So just to swing back round into the risk and the stuff we were talking about, just to recap, is you only ever trade 1% risk per trade, and that's once per day. Cool. That's of your account balance, and that's obviously 1 trade per day is 1 trade per day regardless. On a weekly basis, and this is just my personal approach for risk management, is if you have 3 losses in a week, so if you come Monday, Tuesday, Wednesday and you lose, you don't trade Thursday, Friday. So 3 losses in a week, you're out for the week. And that would limit you to a max of 3% daily drawdown. 3% weekly drawdown.
Right. Okay.
So even on a shitty week, you lose 3 trades back to back to back, you're only down 3%. And that means that you can't blow a funded account in 1 week, which is what a lot of people do. Statistically speaking, I think it's like 97% of people who lose their funded will do it in the first week. This will prevent you doing that.
Okay.
Working off of that, if you have 2 losing weeks in a month, you're done for the month. So if I come in Monday, Tuesday, Wednesday, I lose. I then stop for the week. Come in next week, Monday, Tuesday, Wednesday, I lose. I'm done for the month. Now, this is more my approach when it comes to actually managing large capital, because once you've gotten a funded, the last thing you want to do is lose the funded, because then you're back to square one of doing a phase 1 and a phase 2, and it's just long. So you want to really hold on to that account, and this will limit you from losing anything in a bad month. Because the idea is that if I've come in 1 week and I've lost 3 trades, then come in the second week and I've lost 3 trades, at this point I've taken 6 consecutive L's. I've taken 6 losses. If I've taken 6 losses, I've either just had a complete shambles month, very bad distribution, I've been unlucky, in which case relax, come back next month, or I've had some bad psychology that's led me to making some stupid decisions, or I'm just not trading the system correctly. In either case, it's better for you to stop, look at your data, analyze why you're losing, analyze your losses, and then understand, okay, cool, what can I now be doing moving forward? Again, that means that even on an absolute horrific month where you've taken 6 consecutive L's, because you're only risking 1%, that means that at the worst possible scenario, at a shit month, you're only down 6%.
Okay.
6% is still very much recoverable drawdown. You can still get your account out of 6% L.
Okay.
Again, this will prevent you from going into that statistic of losing your account within 1 week, 2 weeks. Because what a lot of people do is on week number 1, they'll take their 3 losses. They'll take their loss Monday, Tuesday, Wednesday. And then Thursday, Friday, they'll do a madness and they'll lose the account first week. They won't even make it to week 2. They whatever.
Yeah.
By extending your timeline and extending how much time you have to rethink and reanalyze and do all of this, you like lower your probability of losing and blowing your account like substantially.
Yeah. No, I'm starting to learn that it is very, very psychological, isn't it?
It is
It's like, it's like there's a system to follow, but then when you're actually doing it, it's like well, us as humans, we tend to like rebel, don't we?
Yeah.
And then it's only afterwards that you realize, like, oh fuck.
Yeah, 100%, bro. That is literally the trading fallacy right there, mate. You're always doing a madness, and you don't clock you're doing a madness until the madness is done.
Yeah, exactly. So I can fall into like not even just in trading. I'm sure I'm learning, but just like you got to zoom out sometimes, innit? Just need to look at the chessboard.
100%, bro. All right, nice. That is essentially risk management covered.
Fantastic.
Now, how do we calculate our risk? Is another question. We're gonna get into that on the next session because I know you kind of need to dip out here relatively soon. So what I'm gonna do is I'm gonna show you backtesting, show you data collection, how we backtest, what that is, and set you off on like a bit of homework, and then I'll let you do that. All right, cool. Let me do it on the screen real quick. So are you familiar with backtesting and what backtesting is?
No.
Cool. So this is the software that we use for backtesting. It is a paid software, but they have a free trial. Recommend you buy it anyway. It's very useful. It's called FX Replay. It's essentially like TradingView, but it's just a little bit better. It can give you some more features that TradingView doesn't have. And essentially backtesting is all about data collection. It's all about putting price in replay mode, which means looking at previous prices played out and sort of trading the historic price action.
Oh, okay.
So it's a way for you to gather data on your system, gather data about your win rate, about what time things happen, and just get better. And it's practice. That's all it is. It's practice.
Oh, that's sick.
Yeah, but it's based off of real price and based off of things that have actually happened instead of just looking at some BS. Yeah. Now you can do this directly on TradingView. You can go on replay right here and like go backwards and do this shit. But to be honest, it's terrible on TradingView. TradingView, the candles jump. It's just all round. It's not good. I wouldn't recommend it.
All right.
Just use FX Replay.
Okay, cool.
So what you do right here is you come to FX Replay. You come to create a session. I'll bring up this little section right here. You then enter in your account balance. Or you got 100K. Generally, if you're practicing to like pass a funded, I'd recommend entering the account balance of the funded account you're going to take, so you can train your mind to see those sort of numbers and to be familiar with those sort of like those sort of values. You then enter in the pair that you're trading. So for the purpose of this, we'll just go US30. I'd recommend you backtest US30 or NAS. You can also do German 30, but it's pretty similar. You then select the period in time. So let's go back to, let's say 2020 May, and we'll go to the 11th because why not? And then an end date of when you want the section to end. We'll just go current day. So it gives us a nice little section in here. Benefit to this over TradingView is you can go like super far back to like 2018, 2010, whatever. I wouldn't recommend this, but you can go pretty far back and do a shit ton of data collection. Yeah. Bear in mind, the more data you gather, the more repetitions you have, the better you'll be at just trading. So that's kind of how it works.
Bro, this is sick.
Yeah, it is. And you can give yourself a strategy name. If you're trading multiple strategies or making tweaks, you can separate your data. So we'll just call this test.
Right.
Cool. You then save it, and it will come up right here, my 100K test account. I click here, and I go to continue. Now, what it's going to do is going to bring up my chart. Now, you'll notice this is my TradingView chart. They've just nicked it. They've nicked TradingView just embedded inside. So you can come here, you can like re-sort out your candles, have it match your TradingView, and it'll just be your TradingView chart. Cool. Now, what you do right here is obviously you set up your time frames, get your chart all looking nice. And then what I want you to do is go ahead and skip forward to New York session, or just pre-New York at like 12 o'clock. All right. 12 o'clock right here on an hourly time frame. I don't want you to start using some of the concepts that we've gathered. Right now, I haven't given you a system. I haven't given you a strategy. I haven't really given you an approach. I just kind of want you to mess about on FX Replay and have it all play around with drawing zones, seeing how price reacts, stuff of this nature. So for the time being, what I'll get you to do is I want you to start off on a daily time frame. We'll actually add in a couple concepts. I want you to start off on a daily time frame. On a daily time frame, I want you to identify bullish,
Yeah.
bearish,
Yeah.
impulsive, corrective. So are we in an uptrend? Are we in a downtrend?
Okay.
Are we impulsive? Are we corrective?
Okay.
Based off of the answers you get on those questions, you can then decide whether or not you believe it's a day you want to trade or whether or not you want to skip forward to the next day.
Okay, cool.
So if you're in a consolidation and you can't really see any sort of impulsive and you think you're in a consolidation, leave it. If you think you're in a nice bullish impulsive or a nice bearish impulsive, you can then zoom in and find a position.
Okay, cool.
So let me go ahead and skip forward to a day that just seems very, very clear. Cool. Let's wait for price to break out right here. Bullish break. There it is. Cool. So on a daily time frame right here, to me, this seems bullish. It seems like we're now entering a little bit of a bullish impulsive as we come up and break these highs. I think it's a day that I want to trade. Granted, this is not the plan. Again, we're going to get into the first steps of the plan probably in the next session, but just for the time being. Then want you to scale into an hourly time frame.
Okay.
When you're on an hourly time frame, again, make sure you're within your trading session. So always check timing at the bottom. This is 1 a.m. So we're way too early. So we'll skip forward until New York. Cool. Around New York session, you want to identify a key level. So a point of interest. Now, granted, right here, there's nothing to the left that we can draw from. There's no clear level. There's actually not a whole lot happening within this section of price. The overall key level would be this previous high right here, previous point of structure.
Okay.
We're pretty far away from that. I don't know whether or not price is likely to come tap back in and do all of that. But draw a key level. You can then scale into a 15-minute time frame. On your 15-minute time frame, simply wait for price to come tap back in and tap into a level. Once it's tapped into a level, scale further into a 5-minute and you can wait for some sort of behavior. And what I mean by behavior is just wait for some wicks, wait for price to give you an indication that it's slowing down, that it no longer wants to push, etc. And then as a final confirmation, and I don't think it's going to give it to us in this scenario, but as a final confirmation, you simply look for the creation and break of structure.
Okay.
Like that. And then you enter on the break of structure.
Okay, cool.
Now, when you come to enter,
let
me just try and find an example. Granted, this is not a great position, so don't but I'll just enter here for the sake of it. When you put your position, granted, this is your long and your short position. You can favor both of them. So you put your long position. This gray box is your stop loss. Green one is your profit. So you put your stop loss below previous wick or below your structure.
Okay.
And I want to clarify, this is not a trade, but it's just for the example.
Yeah, I understand.
Put your TP wherever you want your TP to be at. For the time being, again, we're trading a 1 to 2, so you want to make sure that your trade always shows a 1 to 2 in the middle.
Okay.
See that? Yeah, 1 to 2.
Yeah.
Then you can come up here to place order, and it'll bring up this order sheet. You want to make sure you're on 1% risk.
All right.
And then at the bottom where it says type, make sure you're not on limit or stop. It should be on market.
Okay.
So you click save.
Yeah.
You're now entered into the trade. So you see we've got the lines, we've got the stop, TP. And now if I play price forward, it will update my floating profit and loss and it will actually move. So it's like I'm managing a position.
This is sick.
Yeah. Now what else you can do as well is if you don't want to play price forward candle by candle, you can actually set it on like a small time frame, like a 1 minute. And you can play it and get the candle to move like that. See that? So it's actually rolling instead of just jumping the whole candle. Moving. Obviously, you can slow it down, speed it up, etc., dependent on what you want to do. You have your floating profit and loss here, etc. So it gives you like a little bit of a feeling of managing a trade in a live market, how you'd react, stuff like that. For the time being, you can just play price forward candle by candle. You don't need to slow it down and do any of that. But just later on, it's beneficial for you to have a little play around with this. Cool.
Definitely.
Now, once you've taken a bunch of trades and they've either hit your TP or SL, so let me take a couple more just so the journal updates nicely. That's going to stop. Yeah. All right, we'll take one more. Come on, mate. an example of a consolidation, right? See, this is why you don't want to be in a range. You just get trapped and then SL'd. All right, solid. All right, so once you've taken a bunch of trades, once you've sat there and you've done a whole bunch of data collection, you've gathered 100 trades or whatever, you go back to the home page. And you can come here and go to analytics. And then on your analytics, it will give you a bunch of insights into your trading. So your total profit and loss, your P&L, your account balance, percentage win rate, total trades. It'll give you a nice equity curve as well. You get insights to your average risk reward ratio, your maximum RR, your ideal RR. Again, we're going to be going through all these statistics, all this data as data collection, and I'll give you insights into how you can use this. One is you get a bunch of analytics into your average trade duration, length, all of this stuff, performance per day, your yearly performance if you're doing a large section, performance per month, and some like
this is lit. Whoever made this is smart.
On FX Replay, it's sick, mate. It's actually a game changer. When I started trading, they didn't have FX Replay. It wasn't a thing. So bro, honestly, when I started trading, for you, I've literally got a notepad in here. Yeah, literally got a notepad where I used to. Look at that. It used to literally just say back testing USD, and then I used to just write shit down, bro. I used to
really? What? But how did you used to watch the replay?
I used to go on like this is my strategy back in the day before any of this stuff was out. I used to come here on a daily time frame on like US30, for example. I wasn't trading at the time. I used to come here, like block my screen with like a notepad. And then I drag it left when I couldn't see. I'd do like something like this. And then I'd zoom in as far as it would let me, and I'll just start trading from like this side. Just, like,
bro, that's sick.
And then I'd be writing down on my notepad like US30 at this level. I took a buy and I try to draw it out.
That notepad's sentimental, bro.
Yeah, it is. It's sentimental.
I'm so lucky that I'm getting into this now. I realize it.
Yeah, I can't lie, there's a bunch, man. That's what I'm saying, bro. Like with FX Replay and all this like education stuff out there, mate. Like it's actually easier now than it's ever been to like do events. Because like, bro, honestly, you can sit here, do like 2 years of data collection, have some solid data on your strategy, really understand you like everything that you need to understand about your strategy, understand whether or not you're profitable or not, and then start making moves in the live market.
Yeah, no, I'm gonna, what's it called? Yeah, as my, so that's what you want me to do as my homework, yeah?
Yeah. So I want you to sit here. Let's say I need at least 30 positions from you.
Yeah, definitely, bro. No, I'll smash it and I'll record it as well.
Yeah, solid. I was just gonna say, go to I'll add you to a Google Drive as well.
Sweet.
Where I do a bunch of lessons and stuff.
Calm.
Cool.
And then I'll post it in there.
Yeah, you can just screenshot it and slap it in here. Cool. I'll take your email after I end the recording, just so the internet don't have your email.
Nice one, bro.
All right. Nice one. Thank you guys for watching the video. If you made it up until the end of the video, top man. Love for the retention, love for the watch time on YouTube. Hope you guys learned something, and we'll be back for episode 3 of the series.
Yes, sir. See you later.
All right, I'll stop recording.